Have you ever heard someone say, we raised our seed round through a convertible note and thought, wait, what does that even mean? Why not just give equity directly? Today I'll break down the difference between equity rounds and convertible notes in the simplest possible way, so that as an investor you know what you are getting into. Let's start with equity rounds. In an equity round, you give money in the startup and in return, you immediately get a fixed percentage of ownership. For example, if the startup is valued at 10 CR and you invest 1 CR, you own 10%, clear, direct and locked in. But here's the catch. At a very early stage, it's hard to put a fair valuation on a startup. The idea is fresh, there's no revenue, sometimes not even a product. If you push for equity, at that stage, you might undervalue or overvalue the company. And that can create problem for both founders and investors later. This is where convertible notes comes in. Think of them as a loan that converts into equity at a later date, when the company raises a proper round with valuation. You as an investor put in money now, but instead of equity today, you get the right to convert your money into shares later, often with a discount at a valuation. Now the two key terms which you will hear, discounts and cap. So say you're getting it on a discount of 20%. So if the next round values the startup at 100 rupees per share, you get in at 80 rupees. Valuation cap is an upper ceiling on valuation for your conversion. If the cap is 20 CR and the startup raises at 40 CR, you will convert at the 20 CR level. These protects early investors for the risk they are taking now. What are the pros and cons? For the founders, convertible notes delay tough valuation conversations and speed up fundraising. For the investors, they allow you to get in early without haggling over valuation, but they do add some uncertainty until conversions. So when to use what? If the startup is slightly mature with some traction, equity makes sense. If it is really early with no clear valuation signals, convertible notes are often smarter for both sides. The important thing is to understand the risk-reward trade-off and negotiate terms that protect your upside. So the next time you hear convertible notes versus equity, remember, one gives you ownership today, the other gives you ownership tomorrow, but with some added benefits. As an angel, knowing the difference could make or break your returns in the long run.